Good evening. It's February 23, 6:40 p.m. Welcome to episode 34, Market Selloff. Good evening to you, Wawi.
Good evening, Mark.
And good evening to our listeners. I hope everyone is safe and having a good week so far. This is your host, Mark Yu.
Wawi Santos.
And welcome to the Mark Yu and Wawi Show. A disclosure, this show is made for sharing information purposes only, not to be considered investment advice. We record once a week. I and Wawi are both physical therapists here in the USA with the same passion and interest in researching and investing our hard-earned money in the stock market. So we missed you guys last week, but this week for sure we're gonna make up for it as we have a good one for you guys tonight. And to our co-workers in the medical field, thank you guys for your hard work. If you guys have missed it, our previous episode, episode 33, we talked about the widespread inflation. As such, the episode was entitled Inflation Galore. We discussed the work from home companies, the fall from their peak of their stock price performance, and different companies and their projections on inflation, such as Kellogg, Pepsi Company, Hershey, Tyson, and Costco. For those who missed it, feel free to go back to the previous episode. So for this episode, we're gonna first look at consumer confidence. So once again, while we were experiencing some dips in February, so this is the data that was just released yesterday, and as often as it comes out, once a month, it still reflects forever, decline in consumer confidence. Now it's at 110.5 compared to 111.1 previously. What do you think about the consumers' confidence or sentiments at this point in time? Are we reaching the bottom, or are the consumers finally gonna start seeing some positivity or reflecting some positivity in their consumption, or at least when they go out to buy their groceries?
That's hard to say right now. All I know is some of the uh, welfare money has been taken away from uh, people, so there's more poverty right now,
Mm-hmm.
and um, prices of goods are going up still.
Right.
Um, I don't think I think people are still buying what they need,
Mm-hmm.
right? Consumer staples, groceries and stuff.
Mm-hmm.
But as of a few weeks ago, I think there's a downturn when it comes to like discretionary items like new cars or
Right.
and, and even those people that are looking for homes are like having second thoughts about getting a new home. So I think the confidence is low.
Confidence is definitely low as reflected in this chart. Uh, I agree with that, definitely, Wowie. According to Senior Director of Economic Indicators, Lynn Franco, quote unquote, interestingly, consumers remain relatively confident about short term growth prospects. While they do not expect the economy to pick up steam in the near future, they also do not foresee conditions worsening. So, quite a contrary, according to this Market Watch article, the bigger picture is the smaller decline in consumer confidence last month than expected is a good sign, but Americans are still worried about high inflation. Like what you said, Wowie, he said here, or she said, fewer people plan to buy homes, cars, autos, and appliances in the next 6 months, the survey found. So definitely is showing up at this point of time, whereas we have been starting to see this decline even months before, around November period. So as you've said, the retail sales actually had dipped a little bit. Well, this was in December. Sorry about that. Erase that. So when you mentioned the word poverty, Wowie, that made me quickly type a Google search here about
Hmm.
personal savings rate.
Hmm.
Unfortunately, the data provided by the government hasn't been updated yet. The latest data is as of December 21, 2021. So it's still at 7.9 percentage, which in contrast, the last 5 years it was hovering around between, I'd say, 7.2 to at least 8, just before the COVID pandemic. So at least savings rate as of December is quite relatively steady. What would kind of like surprise me would be a savings rate that would dip below that or be trailing around 6 percentage points. So that made me also look at the financial conditions index, which we regularly take a look at because this Chicago Fed National Financial Condition Index provides a comprehensive weekly update of the financial conditions here in the U.S. because it takes a look at money markets, debt, and stock markets, and including traditional and shadow banking systems. So the higher that this graph goes, the tighter the money or the financial condition is for everybody else, not just the mom and pop, but also the investors. So as you can see here, as we've been reflecting on it from time to time, it's still ever increasing. As of February 11th, it's still in the negative territory, indicating that it's the money is still a little bit loose. But ever since July of last year, money has been increasingly getting tight. So now we're gonna go into our weekly sentiments and flows. So we've got a good one for you tonight because this part right here of our weekly segment is packed with charts. So prepare for it. So hopefully you guys find it informative. If you like it, please subscribe or hit the like button at least. So for now, we're going to start with the American Association of Individual Investors. So this is a weekly survey provided by the institution, a nonprofit organization, which asks their investors, group of investors, which direction do they feel the stock market will be in the next 6 months. So as of February 16, we have dipped below 20%. So ever since we started the podcast back in mid last year, we never saw the bullish sentiment dip below 20%. So this is as of February 16. We are 19.2. It was less than the previous week's number of 24.4%. For bearish, we're at 43.2%, a little bit more bearish compared to previous week's 35.5%. So individual investors are quite pessimistic right now. Wowie.
Yeah. So that reflects my sentiment, my own personal sentiment too. I, I'm holding back on the big ticket item, like buying a new car.
Right.
We have like a car that's like uh, about 20, gosh, probably close to, well, not 20 years old, but close to like maybe 15 years,
Oh
and
wow.
we need a replacement, but we're waiting for them to have the model we want available in 6 months.
Wow. That's quite some time to wait. And hopefully you
Eh,
don't overpay.
yeah, it's for a Kia Telluride.
Right.
So we were
Well,
told we have to wait for our pick
mhm.
for about 6 months.
Well, as long as they deliver it without any missing parts, right? While we any missing semiconductor chip with the Bluetooth functioning and all of that.
Let's hope it has a chip.
Yes. Well, now jumping on to our next graph, volatility index. So this reflects the up and down wild ride that the S&P 500 has reflected. So for the
Yeah,
past
that's
week,
up.
yep, it was just for the within the past 5 days, it's up 16.7% to 31. And if you're going to look at from the start of the year, we're back at its peak since January 1st. And it's now up 87% since the start of the year. For the Nasdaq volatility, which is the VXN, for the past 5 days, it's no exception. It's up 13%. And since the start of the year, it's going up there as well for the Nasdaq or the tech heavy index. For the fear and greed index, we closed at 26, whereas previously we were at 41 just a week ago. So people are getting more bearish. If you're going to look at in a graph for over time, we haven't seen this bearishness since late last year. Uh, for today, there was only one sector that's positive, which is the energy. sector, and the rest are in the toilet. Not well, not in the toilet, but negative at least. For the past week, we didn't have any industry that outperformed. Although energy is slightly negative, negative 0.29%, followed by consumer defensive. The rest are down quite big, especially technology. Since the start of the year, amazingly, there's only one sector that's in the green, and it's in the green by quite a good amount, 17.72% for the energy sector. For financials, which people are expecting to outperform, it's actually down negative 1.83 as a group. For technology, it's the worst performing sector since the start of the year, down 17.66%. Terrible performance by technology. Any thoughts on this, Wowie, about the technology and energy sector?
Well, the Nasdaq index, which carries a lot of the technology stocks, has seen the greatest decline compared to the other two indexes. Um, Usually that happens when there's, you know, increase in like in like interest and inflation. So yeah, definitely they were hit hard. Tech stocks were hit hard.
Right.
Um, my portfolio is heavy on the tech, and I think I'm down more than 25%.
Wow. How are you
Um,
handling it, Wowie? Are you planning to buy the dip as we've traditionally did for past
mhm.
couple months, or are you planning to hold on and wait until Fed says something on March 15, or what's the next step for you at this point in time?
Yeah, so this is not an investment advice, and it's really bad to time the market. But I'm kind of waiting for the Fed to do something, and
Mhm.
then, but I'm thinking that we haven't reached the bottom yet of the valuation, for pricing things in for this current geopolitical situation,
Right.
Russia and Ukraine.
Just came
I
out of
don't.
nowhere, right? Well, sort of.
Mhm. Yeah, we're kind of like thinking about that. You know, we're okay, without any, you know, unforeseen, event. And this is the unforeseen event
Mhm.
that for me that I didn't like think about, what's going to happen in Ukraine. I'm thinking
Right.
something might happen in the Middle East
Yeah, which is
or
more
in China,
likely. Yeah.
yeah, or in China or Taiwan, but I didn't know that we're going to have something happen in Ukraine.
Mhm.
But, since I think they're estimating that the economic effect of, Russia, on the market is just like maybe 1% of the
Mhm.
global economy.
Okay.
And so they're kind of like, doing the sanctions right now, UK, Germany, and now the US
Yeah.
financial. Um, but you have to think, um, who's going to benefit here would be the oil companies in the
Right.
short term,
Yes.
because so you're going to look at energy,
Mhm.
because Russia's economy is dependent on oil,
Right.
and with the sanctions in place, it's going to seek refuge, and supply from China.
Right.
So who's going to
Yeah.
benefit from this would be our oil companies and China.
Yes. Now that you said that, yeah, definitely unforeseen. I mean, Russia and Ukraine have long history, even back in early, well, 2011 or 2012, when they have some encounters over there. Even before the annexation of Crimea back in 2014, they already have some issues. So it could be a black swan, kind of. But now that you said also about this kind of geopolitical issue, it kind of reminds me of that quote by Albert Einstein, I think. Like, I'm not like what he said was, I'm not sure how World War III is gonna be dealt with or fought with, but I'm sure like we will be fighting with sticks and stones on the Fourth World War or the World War IV. So something to be definitely be worried about. I guess that's why the market is showing some kind of like fear at this point on time. But lucky for our listeners, I saw this chart from, I think it's from ZNBC, indicating which companies have a big exposure to that area, East Russia. So we're gonna see that, or Eastern European continent. So we're gonna see that in a little bit. Going back to our outperforming industry, which is the energy. So long before, these are the value stocks before they entered this year. So they were trading really cheap. I remember inviting over Dr. Stephen. He actually pointed out one specific company in that field or in that industry, which is Exxon, which has done nothing actually since 2016 or 2015. But now we're going to see in a little bit how it is performing. But initially, we were looking at it as a value play, oil companies and banks. But now it looks like it's also diving into a good inflationary hedge. And now that we have this geopolitical event, like you said, Wowie, with oil and gas in some trepidation, looks like it would still carry on the torch as the only industry that's on the green for the next succeeding weeks or even if not months. And
Mm-hmm.
knowing that they have cut so much production, well, not so much, but at least somehow, even employees, I just saw a notification from Reuters before I clocked out from work earlier that Exxon just cut 9,000 jobs from their payroll because of their cost cutting measures. So definitely, these big oil companies have learned their lesson and not just pumping out oil like crazy. They want to maintain a
Yes.
certain output and they want to make sure that they're profitable. So even though the interest rates would increase, I doubt that these companies would suffer any hardships moving forward. So they'll be able to carry on the torch more likely in the near term future, which is something to watch out for, as they are the only industry that's on the green, much more so
Mm-hmm.
compared to the rest of the industry so far this year. So put call ratio, me and while we started including this since the start of the year, this is the tail that wags the dog, as I would like to say. Put options, meaning it's kind of an insurance in case there's a market sell off. Call options is betting that the market will go up. So right now, put is definitely more than call. We are seeing um, a little bit increase. We're seeing levels of put call ratio not seen since late last year, somewhere in October when we had the sell off. So people are bearish, really, so being supported by different types of data at this point. So this is a chart from CNBC that just got published this afternoon. So S&P 500 is now in the correction mode. We're down more than 10%. So for those who are not aware or not familiar, 10%, once a stock drops or an index drops by 10%, that's also called as a correction. And once a chart or once a stock or an index falls down by about 20%, that's called bear market territory. So, as what Peter Lynch, a famous money and successful money fund manager back then, would say, bear markets or corrections is a euphemism for someone or a group of individuals losing a lot of money in a short period of time. So
Mm-hmm.
that's what we are at right now.
Yeah, and
Uh,
that's what we're seeing a lot. A lot of uh, the correction is happening on the tech stocks, the overvalued, high PE
Super, yeah.
ratio. Hmm.
If you guys
They,
don't know, I know you probably already have observed this company for sure, Huawei. It's a company called PayPal.
hmm. Yeah.
This company, oh my gosh, this company has just lost a lot of money in terms of their valuation. So at one
Hmm.
point, they were at $266 at one point last year, but now they're down to $100 a share. They lost 62%.
Hmm.
$10,000 invested last year, over a year ago, is now around roughly 30 or $3,700. So you lost almost like a lot of money on this company. So at one point they were at more than $200 billion. even
Mm-hmm.
worth more than some of the banks in Wall Street. Now they're down to 117 billion. I mean, 117 billion, don't get me wrong, that's still a lot of money, but
Mm-hmm.
they erased more than $100 billion in their capitalization. So, stock market is no mercy at this point of time. So we've seen earlier on Netflix when it dropped crazy 20% in just one day. That's when Bill Ackman bought some shares. So it quite bounced back a little bit from there, I think. But yeah, so jumping on to our next graph, which is the flows. This one we're lucky to get information from Bank of America, Merrill Lynch. So according to their study for the past week, we saw heavy outflows in ETF, primarily in materials, real estate, utilities, consumer discretionary, and we've seen strong inflows in healthcare and obviously energy, followed by financials. So the performance looks like it's trailing wherever the money's going. So clearly reflecting. So ETF and financials saw the biggest inflows on this following succeeding chart by Bank of America. Tech obviously is the worst in terms of having a lot of outflows. So this is a screenshot that I took from a Bloomberg report. From its peak, communications, which includes Facebook, Snapchat, and those companies, are down. Well, they actually are in the bear market right now, down
Mm-hmm.
21.5%. Interestingly, discretionary down 17.8% from their peak. So right now we're actually in the bear market, guys. I just realized that. Damage at the
Mm-hmm.
top. So they further magnified the big tech here. So from the peak, from all-time high, Microsoft is now down 9.2%, the biggest loser of the FANG stocks, followed by Facebook, 8.1%. I doubt that that's the only. It just dropped like 20% at one point last week. But yeah, Apple is down from its peak 5.2%. Oh, six tech stocks cost us 35%. Well, I'm sorry about that, listeners. And sorry about that, Wami. So I guess if you add all of this up, Amazon, Nvidia, Tesla, Apple, Facebook, Microsoft costs at least 35% of S&P 500 fall. So
Yeah.
these big tech are dragging the index down. My apologies on that. So according to a quote from Bank of America analysts, the fate of tech is far more important to the S&P 500 than geopolitics. The S&P 500 or S&P's direct Russia sales exposure is 0.1%, but information technology plus communication services are close to record weights of 37%. So whatever happens in Russia and its stock market, it's just 0.1% of the S&P 500. So
Mm-hmm.
what is more important is the big tech, regardless of what the situation is over there. If they're gonna get into war or another conflict. So this is a chart that I included. This is from Yardeni. He provides very good informative charts. So the market share, as we just talked about, of Google, Amazon, Apple, Facebook, or Meta platforms, Microsoft, and Netflix are now hovering at 20.8% of the S&P 500. The
Yeah,
f-
and that's
uh-huh.
why I'm advocating some equal weighted um, investment on the index
Right.
to kind of lessen the blow of this correction.
Right, because if you're gonna buy an S&P 500, definitely 20% of your money is gonna go into the big tech stocks. If you would like to diversify more, I think that's a good option right there, equal weighted instead of like being exposed mostly to the big tech. Yeah, consumer discretion. We just talked about that. Here we go. The profit margin of the big tech. So these are the most profitable companies in the USA. So Facebook, it's a 27.1% profit margin. So I'm not seeing this to stick around because they've been spending a lot of money, 10 billion here, 10 billion there for their what do you call that? Metaverse.
Mhm.
Amazon obviously is the least profitable company in the group. Its profit margin is just 4.8%. And mostly it's because of their cloud services, not even their retail. But we're gonna see that. I'm excited to see their actual profit report 3 months from now because they just increased their Prime membership that we just discussed a couple of podcasts ago. The most profitable one is Microsoft, 35.9%, followed by Google, 27.7% profit margin, followed by Apple, 26.4%. So if we're going to just take a look at the big tech, Google, Amazon, Apple, and the rest, right now, their forward or a year from now, price to earnings ratio is hovering around 20.3 times. If you take them out of the S&P 500, the S&P 500 is at 18.9 times. But if we're going to take a look at the average of PE ratio for S&P 500, I think we're still trading at above the average. So if we're going to look at this free website, multiple.com, the average S&P 500 PE is at 15.97. So right now we're at somewhere between 18 and 20 times. So we're still a little bit pricey compared to the
Mhm.
average of 16 times. So if you're the
I think
bearish,
that's
Mhm.
yeah, and I think that's where they're basing the bottom to be at,
Like around 15,
around 15 or 16.
that's a good call. If hopefully that's the case, because if we're gonna look at individual big tech stocks, Facebook is right there, 15.9 P ratio. So after the big drop of losing 40% of its value for the past year, Facebook is at 15.9. Amazon is still up there at 58, Apple at 26, Netflix 34, Google at 21, the second cheapest one, if I may say, cheap at 22 times, Microsoft at 28. So yeah. Now we're gonna be tackling some of the random charts that we decided to include in this podcast. Since we told you we have a good one for you tonight. So mortgage and refinancing. This is from an article from CNBC. Just a phrase copy pasted. It said climbing mortgage rates. This is about real estate now. Climbing mortgage rates are hitting both potential home buyers and refinance candidates. Total mortgage applications decreased 13.1% last week to their lowest level since December 2019. So not so much mortgage applications happening now in real estate, according to Mortgage Bankers Association. Refinancings dropped 15% last week. Home prices have been climbing steadily during COVID and didn't let up last year. So some slowdown in real estate finally hitting the data, Oawi.
Yeah, and that's to be expected
Mm-hmm.
since home prices are way up there.
Right. It's been increasing 20%, 28% in some areas. Phoenix, I believe, is the hottest city in US. So this is a State
Mhm.
Street survey. We might start including this as well. It's just something to do with stock market sentiment and financial conditions. Interestingly, at February, it increased to 103.9 compared to December and January, which were negative. So we might expound on this more in the coming episodes. So this is the chart that I was referring to. S&P 500 revenue exposure to Russia. So the most exposure, the company that has the most exposure in Russia looks like is Philip Morris, ticker PM. It has 8% of its sales exposed to Russia, followed by PepsiCo at 4.4%, followed by Mohawk, McDonald's, EPAM, Carnival Cruises, interestingly, PVH, Wob Tech, Mondelez, which owns, I think, Oreos, and followed by John Deere. So if anything, these companies are the ones heavily exposed in that geopolitical conflict. So looking at closely at some of the specific stocks and index performance since the start of the year, best performer is Exxon Mobil in this chart. It's up 20%, 20.82%, outperforming the index itself. The index itself is around 17%. Berkshire, which is a value stock, up 3%. Emerging markets, which interestingly, Wall Street has been trying to get investors follow through with investing in emerging markets, aside from, diversifying from U.S. stocks, which is grossly overvalued, as one would put it. Emerging markets EMB ETF is down 7.4%. Financials such as JP Morgan, it's down 8% since the start of the year. The S&P is down 11.9%, well below correction territory now. Google, one of the big tech, down 12%. Nasdaq, ugly, down 18%. This is I added Russia ETF here, ERUS. It's down 31.3% since the start of the year. Most of it was, of course, just a couple of days ago, over the weekend, when the Ukraine and Russia issue has sparked. So it's down 31.3%. Tesla is down 36.3% since the start of the year. ARK Investments, Kathy Wood's ARK, is down 37%. Facebook, this is the worst performer in this group, down 41% since the start of the year. Pretty ugly. So we're now going to our roll the clip segment. Do you have anything to add before we roll the clip, Wawi?
Yeah, I think this is a call for patience and resilience on the market. It's not like it's not happened before, but you
Right.
have to realize that we have 20 million new investors on the market and they have not experienced this type of correction.
Exactly. Yeah,
So,
that's a good point. Yeah.
so they're gonna be a bit more skittish than those that have experienced corrections like in 2008.
Right.
Um,
Exactly.
so this is not unusual. This is what happens,
Mm-hmm.
when there's a geopolitical event as big as this one coming in, um, home mortgage crisis in 2008. I'm just saying this is the time to just, if you're a long-term investor, best time to just stay patient. What you will do, if you like panic at this time, will may cause regrets later
Mm-hmm.
down the road if you just look at history,
Right.
how the market performs. What you do at this point of correction or later on if it corrects some more will determine your gains in the future.
Right.
So just having to just need to remind our listeners that it's best to hold on the long term, if especially on your conviction stocks
Mm-hmm. Mm-hmm.
or indexes,
Right.
rather than sell.
Right. Wow. Those are really like good advice, Wawi. We need to put that as a quote.
I guess that's my code for the day.
Yes, sir. Well, it's really informative. Hopefully, most of the investors now that are exposed in the stock market can stomach it. It's not that easy. I mean, if it's already bothering your sleep at night, I mean, you better do something, or at least, try to regain your composure. Try to think why, in the first place, you invested in the stock or in these group of stocks.
If you're
If you
looking
don't,
at the Yeah, if you're looking at day-to-day graph, how things are going up and down,
yeah,
you know that a lot of these investors, individual investors, are buying the dip.
mm, you're
Yeah,
still buying. Yeah.
they're still buying the dip.
Well, we'll see how it goes, especially when the Fed comes up with their Fed meeting next month. How the market reacts. But yeah, all right, we're jumping on to our roll the clip segment. This is a segment where we're gonna play a bullish and a bearish thesis, or at least comments from well-renowned, Wall Street personalities. So in this first video, entitled "Market is a Super Bubble That's About to Burst," according to Grantham. This was published on February 19th with 272,000 views from Fox Business. Let's play.
Famed investor Jeremy Grantham has been calling market bubbles for decades. And he says right now we're in a super bubble that's about to burst. Is there anything investors can do to protect themselves? Joining me now, GMO co-founder Jeremy Grantham. Thanks so much for coming on the show, Jeremy. I appreciate it.
Hi, it's a pleasure.
So first of all, could you just define super bubble for us? You say this is only the fourth one in the past 100 years.
Yeah, about 30 years ago, we thought it was a good idea to define what a bubble was since everyone was talking about it. And we picked a measure of statistical kind of outlier shit that would be once every 44 years in a random world. And statistically, that's 2 sigma. And that was what we would call a regular bubble. And you would expect trouble. When they hit 3 sigma, which is the kind that should occur every 100 years, we call them super bubbles. And there have only been a very small number of those, 3 of them in the US equity market. This one, the 2000 tech bubble in 1929. There's been one in the US housing market too in 07.
Okay, so you say that the S&P 500 could fall by almost half to about 2,500 to get it to fair value. It can even fall below that. So if that's not scary enough, you point out that on the behavioral side, investors are acting very bubbly too. Can you give your favorite examples there?
I think the idea here to get your brain around is that there's a huge commercial imperative for the big firms, the banks, the brokerage houses, the Goldman Sachs, to play right up to the end. It's hugely profitable. They're never, as a firm, convincingly bearish, ever. And they never will be. It doesn't make commercial sense. But at the top, even though they feel the commercial imperative to be bullish, they're thinking to themselves, but my God, the market looks expensive. So I'm darned if I'm going to dance over the edge in Puma Tech in 2000. I'm going to dance over the edge in Coca-Cola in 1929 or Coca-Cola in 2000. And it works. When the end comes, it is always better to have danced off the cliff with the great blue chips than with the specs. And the defining feature of the great bubbles, the super bubbles, is that towards the end, even on the upside, as the S&P and the blue chips go up, the super specs that have led the market for the previous few years start to go down. They don't even underperform. They get the sign wrong. Today, as we sit, well over 40% of every stock on the NASDAQ is down over 50% from its high. So this divergence, which is very rare, occurred in 1929, occurred in 1972 in front of a good bear market, occurred in 2000, and is once again, has started since about the spring of last year.
ARK Innovation is a good poster child. That fund is down more than half. So at this point, of course, investors are wondering what to do, selling everything and then waiting for Jeremy Grantham to say, buy now, doesn't seem like a great strategy. So what should investors do with their portfolios at this point?
Oh, by the way, I did write my letter, Reinvesting When Terrified, at the bottom of 09. So that would have worked pretty well that time.
I will endorse that. I know you did. I wrote about it at the time, and you deserve great kudos for that. 666 on the S&P.
What I would do is make sure you have some cash reserves. There may be some great buying opportunities in the next couple of years. Secondly, I would try and avoid US stocks. If you have to own some, I would own high quality. They always do better in a serious shakeup. And this has the ability, as all bubbles breaking do, to cause a credit crisis somewhere along the line. It may not, but it well may. And so blue chips are the way to go. Avoid debt, avoid specs. And to the extent you can, avoid the US. It's the most overpriced market. Real estate is overpriced everywhere in the world. But the stock markets outside the US are curiously not that bad. They're in a bull market, they're overpriced mostly, but they're only normally overpriced. And there are a few cheap countries. Japan looks pretty cheap, UK not so bad. And if you looked at emerging markets, you would find some cheaper countries there too. And within the countries, if you looked for the cheap stocks, growth versus value. Growth has had an unprecedented decade. It is probably the turn for cheap stocks again. So emphasize cheap countries, cheap stocks, avoid the US. And if you have to buy the US, for heaven's sake, pick the quality stocks and have a cash reserve.
And that's, of course, fantastic advice for Americans who tend to have a home country bias and be overinvested in US stocks. That's worked over the past decade, but it's high time for that to reverse. Jeremy Grantham, I can't say it's necessarily a pleasure to speak with you, but it is a wonderful gut check. There's not enough skepticism out there, so thanks so much for sharing that.
For heaven's sake, avoid US stocks. What do you think, Wally?
I think he's right. I think a lot of our large cap companies are overvalued.
Overvalued indeed. Yeah, we just take a look at that. If you guys want to review that part of we just discussed the forward price to earnings ratio. That's one way of determining the valuation of a company. Anything above the average, which is right now, our S&P is around 18 to 20 times. Anything above that is overvalued at this point in time. If it's less than that, it might be in the valuation territory and it's goodbye. But we're not advising you to buy any stock right now. But yeah, it's good to stay in within the market. And it looks like Mr. Grantham here is definitely on the pessimistic side of things, despite the sell-off that's already happening, which started since the start of the year, actually. So you see, he's thinking that there's going to be a good buying opportunity in the next couple of years. So
yeah, his time has come. His time has come because Jeremy Grantham is like he's got a nickname, Perma Bear.
Perma Bear, yeah, permanent bear, which always sees the downside of the market. So yeah, we're gonna jump on the next roll the clip segment. The only video that we have left for this episode. It's entitled "This is a Good Risk Reward Moment for Stocks," says none other than Fundstrat's Tom Lee. So
wow.
this is an interview given by CNBC.
My man.
It was published just yesterday, garnered 75,582 views. Let's roll the clip.
Fundstrat's Tom Lee remains optimistic about the market and joins us this afternoon to talk more about the geopolitical tensions we're seeing. Tom, good to see you again.
Great to see you, Carl and Morgan.
You said in prior times of stress that it's not a good time to be a hero. Is this one of those times?
Well, it's been a very difficult setup for markets because we were already seeing markets struggle with inflation and Fed hikes and rising rates, and then now we have a real escalation of geopolitical tensions. And that's correct. It's tough to be a hero, but I think investors are on that sort of cliff edge, and I do want to just encourage people. This is a good risk reward moment for stocks. I know it's kind of ugly today and it's been a very ugly few weeks, but I would still sort of lean pretty hard into this and say, this is not a time to be selling stocks. I'd rather be a buyer here, even if there is potentially some downside.
I was going to say, it sounds like your view for the first half in general is somewhat treacherous before you see the markets improving in the back half of the year. If you were to get in around these periods, you'd be in for a few months of where it would demand you to be patient, I guess.
That's right, Carl. I mean, I guess, in December, we thought, it would be very difficult to make money in the first 6 months of this year. But now we're in February, the market's down 10%. I mean, I think the one thing that we all have to ask ourselves is, how much more bad news can happen between now and the end of the first half that would push stocks down. And this is where I'm really starting to think that, maybe a lot of that downside that we thought would happen sometime in the first half, down 10%. I mean, we're in pretty much here. So, I know we're in a buyer strike, and I know investors are nervous, and nobody wants to see global conflict and deaths and civilian casualties. But at the same time, we should also just even look at what the market's telling us. I mean, Ukrainian stocks are actually outperforming, and they've outperformed for the past few days, even as Russian stocks are underperforming. So from that perspective, I almost would say a half full glass perspective that it may not be as bad as we think.
May not be as bad as we think, Wowie.
Mm-hmm.
Coming from Fundstrat's Tom Lee.
Yeah, and that's just staying level-headed is what he's trying to say, I think.
Right. And if anything, he said it's not the time to be psyched out of the market. If anything, it might be a good time to buy.
Yeah, yeah, and I've said I've been waiting for the Fed to do something before I like maybe do something like buy something.
Mhm.
I hate to say this, but I'm also like trying to buy the dip.
Mhm.
But I'm just like saying, oh, this is not yet the dip. I'm gonna, but that's not the right thing to do. The right thing to do is just keep investing. You got a few $100s here every month. Put it in the market. And just keep reinvesting that way.
Right.
Um,
Like
and
stay. Mhm.
you got to look at Warren Buffett, right? What made him rich is really, you know, he's had 80 years,
Right.
playing the market. That volume of time is what helped him, become, I mean, that company, 1964, Berkshire Hathaway up to now, like, it's the time,
Right.
that you are in there and that you're not panicking and you're like,
Just holding your ground, right?
yeah, and he did that, and he looked at companies that were like, they were just like Coke, right?
Mhm.
Coca-Cola,
Like
right?
simple companies. Yeah.
They're simple companies. He's not chasing something like, oh, this is gonna be big one of
The
these
next
days,
big
right?
thing. Yeah. Totally agree with you, Awi. Time is on our side as long as you're investing for the long term,
And
I
one
guess.
thing about them, although they're conservative, they also look into like new things, right? Apple was one of his biggest winners
Mm-hmm.
for Berkshire,
Yep.
but it took him a while. I think he saw his granddaughter or something using
Right.
Apple,
With an iPad and made him use it, and
right? So he's
he liked
open
it
to
more.
new ideas.
Right.
And as of recent, I know Charlie Munger kind of disses Bitcoin and all that, but they're
Yeah.
investing on a bank, right, in
Mm-hmm.
South America called Nubank,
New bank.
and
Yeah.
that Nubank is like a banking company that's uh, transacting in cryptocurrency. So they're not like closed-minded, I would say.
Right. Maybe some
They're
diversification to
mhm.
crypto as well, regardless of the small exposure that they have.
Yes.
Yeah. But I guess as long as you have that conviction, Wowie, I think the investors will be fine over the long term, regardless what the tomorrow does or a year from now does. As long as you
Mhm.
believe in the company, as long as the company is making money or delivering its promises, I think it'll be fine. Hopefully, that will be the case. So,
Mhm.
like Tom Lee just said in previous interviews, I remember, and the interviewer remind him or kind of like just reviewed what he said. It's going to be a treacherous first half of the year, and then for the following 6 months, it will be at least smooth sailing, all new time highs again. So we're gonna see. So this is just a clip. We're almost done. For those listeners who have just tuned in or we're still listening, please hit the subscribe and like button and share if you appreciate this podcast so far. So this is an article from CNBC that just was published this morning. Title is "The Number of U.S. Cities with an Average Home Price of $1 million Tripled Last Year." So this just shows like how hard it is to buy a property at this point in time. "Quote unquote," the surge in demand for housing last year sent home values skyrocketing, even in places where prices already were sky high, and that helped tip a record number of cities into the $1 million club, according to Jeff Tucker, senior economist at Zillow. As a result, first time buyers are getting priced out. And this is a group that I joined on Facebook, something to do with real estate. She just posted this yesterday around 5 p.m. "Quote unquote, out showing a home today priced a bit above 250K somewhere in North Carolina. I think it's Raleigh housing crisis still in full effect, according to this realtor." So I'm gonna just roll the clip. This is a 1 minute and a half.
Everyone, so I am here showing my client a home. And I just want you to take a look at all of the people who are lined up to see this property. So when we say that there is a housing crisis, we really, really mean it. It's absolutely insane. The line goes all the way in the back. It's not even 5:30 fully. And someone stopped me and they wanted to know what was going on in the neighborhood. And I just told them the truth. I said, we're having a housing crisis. And this is a home that is priced under $300,000 here in the Raleigh area. And as you can see, there are just cars upon cars upon cars. And there are a ton of people that are trying to see this home. This is absolutely ridiculous. We have got to get control over these prices in the housing inventory. Absolutely crazy.
So I guess a couple of things that I can take from that video is like people still have the buying power, Wowie, and
Yes.
even though the consumer sentiment is reflecting otherwise, we're actually seeing more demand and ability to purchase, regardless of the price of that piece of you know good or property or car or whatever. So
I
it's
think in comparison, that $250,000 price for that home, if you're looking around the area and looking at the homes in that video, I
mhm,
think that's a good pricing
pretty
range.
pretty cheap.
Hmm.
Maybe that's why people are piling up to see the showings.
Yes, yes.
So before we end, this is a article from the Guardian.
Mhm.
Aside from the fact that who did just say that there's only 0.1% exposure to Russia? I forgot. But yeah, the
Yeah,
S&P
on
yeah,
the S&P 500, yeah.
yeah, the S&P 500 has only 0.1% exposure to Russia. This is a article as well, kind of like, dampening the mood. So the sanctions were provided, including what the United Kingdom, I guess, provided. Like they've uh, whatever they they imposed on Russia. This article said these pathetic sanctions won't hurt Putin. He'll be laughing all the way to his dacha. I don't know what even dacha means, but let's
I
see.
think it's a bathhouse.
Oh, a cottage, a country house or cottage in Russia, or a
Oh,
vacation home. So, I mean, if this were the case, and we United States already imposed some sanctions, so hopefully, it won't do us a lot of damage in the stock market's sentiment. And this is a timely report provided by no other than, well, we don't have his interview this week or past couple weeks, but this is Mike Wilson of Morgan Stanley. So he came out with a report that was published in Bloomberg. It says here, I'm just going to read it out to our listeners because this is very vital. The bottom line for us is that we really don't have a strong view on the Russia Ukraine situation. We think a lot of bad news is priced at this point. Signs of de escalation could lead to a relief rally in the near term, given the lack of hard evidence for our ICE thesis. However, risk of tensions escalating is elevated, and come March, the Fed will actually begin to tighten policy as opposed to just talking about it. This will come just as the data begins to roll over with respect to growth, more specifically, decelerating earnings revisions and more acknowledgments from companies that demand may be slower than anticipated as supply comes online and costs remain an issue. So not so much upbeat there from Mr. Mike Wilson.
so I'm thinking, Russia can extend this uh, situation.
Mhm.
It can extend it indefinitely, depending on uh, its ability to sustain its country.
Right.
Uh, amidst the sanction.
Mhm.
Well, countries like Iran will benefit because now Iran can like supply some of the shortage of oil in some of these countries.
Yes. Well, most of
But
the time it's the companies or the countries that have a lot of exposure to commodities, supplying oil primarily, like the Middle East and like what you said, Iran, and obviously Russia, regardless of the sanctions. Well, Wowie, I guess we're gonna go by your quote earlier.
yeah, well, I think based on
Mhm.
what's going on right now, and
Uh-huh.
I'll go with Morgan Housel's quote, and it's about Napoleon Bonaparte. So
Okay.
Napoleon Bonaparte defined a military genius as the man who can do the average thing when all those around him are going crazy. Okay, so that's from Napoleon Bonaparte.
Let's see.
So you so
Uh,
when things are like crazy and chaotic right now, the best thing you can do is just be an average thinker, average person.
to be an average person instead of like panicky or anxious type of person, right?
Yeah, and doing actions that are not like your normal.
Mhm. Which could eventually lead to a regret later on. Like what you just said, this will reflect on your gains or losses in the future if you're not careful with your investments at this point in time and if you're not careful with your actions.
Mhm,
Well, a quote well said, Wawi, and thank you for another quote that we could go by before the weekend.
mhm.
I appreciate you joining us this evening, Wawi. You're still fresh off the clinic. You're still in your
Yeah,
scrub. Truly appreciate your time, sir. Well,
yeah.
Wawi,
Thank
thank
you.
you, thank you for so much for coming on. And listeners, I guess that does it for this podcast. If you have any questions, please send them over at markyowawishow at gmail.com. And remember, build that emergency savings and for a better future, invest the rest for an abundant retirement. Again, this is Mark Yu
Wawi
signing
Santos
out.
signing out.